AI is quietly changing the way money flows in the world, and most investors don't even realize it yet. For over 35 years, one simple strategy helped generate millions. But recently, something didn't feel right. So I made 5 major changes to my investment strategy, and today, I'm breaking them down for you. Stay with me until the end, because the last move could completely change how you think about investing. And real quick, if you care about building real wealth, drop a like and tell me in the comments, are you focused on long-term investing or quick gains? For decades, my approach was simple. I invested in the S&P 500 index fund. This is called passive investing, where your money automatically spreads across the top 500 companies in the US. You don't pick stocks, you don't time the market, you just own a piece of everything. And over time, this strategy has worked incredibly well. Even when some companies fail, the overall market continues to grow. Simple, consistent, and powerful. But then I noticed something most people completely ignore. Today, when you invest in the S&P 500, you're not as diversified as you think. Almost 40% of your money goes into just 10 companies. Companies like Apple, Microsoft, Nvidia, Amazon, Meta, and Tesla. And here's the shocking part, one company alone, Nvidia, can take up around 7 to 8% of your investment. That's because the index is market cap weighted. The bigger a company becomes, the more of your money it receives. So naturally, one question comes up, why are these companies growing so fast? When you look closely, there's one clear answer. Artificial intelligence. Almost all of these top companies are aggressively investing in AI. And at first, that sounds like a good thing. AI is the future. But here's where things get interesting. For these companies to justify their current valuations, they would need to generate trillions in future revenue. Not based on what they earn today, but what investors expect them to earn tomorrow. And that's where risk starts building. There's nothing wrong with betting on the future. But when the entire market depends on one idea, things become fragile. Many of these companies are spending massive amounts of money on AI, sometimes far beyond their current earnings. And when money starts circulating within the same system, it creates a feedback loop. Prices go up, more money flows in, and prices go up again. Everything looks strong on the surface, even if the foundation isn't as stable as it seems. So the first change I made, I reduced how much I rely purely on the S&P 500. Not completely, because it's still powerful, but enough to reduce concentration risk. Now you might be thinking, why not just spread money equally across all companies? That option exists. It's called an equal weight index fund. Instead of focusing heavily on the biggest companies, every company gets a similar share. On paper, it sounds perfect. But there's a catch. These funds constantly rebalance. That means they sell companies that are performing well and buy more of the ones that are lagging behind. In simple terms, you're selling winners and buying losers. And on top of that, frequent trading increases costs, which slowly eats into your returns. So instead of switching completely, I made a smarter move. I started thinking, what if the next big opportunity doesn't come from the US? It might sound strange, but history shows us that market leadership always changes. At one point, the UK dominated global markets. Then Japan surged. Then the US took over. Nothing stays on top forever. And when you only invest in the US, you miss out on global giants like Samsung, Toyota, and TSMC. These are massive companies driving real growth across the world. So I started investing in global index funds, covering thousands of companies across different countries. The benefit is simple. Automatic rebalancing. If one region grows faster, the fund adjusts. If another slows down, it adjusts again. No guessing, no predicting. Now here's where things get really interesting, because the next move isn't just about reducing risk. It's about finding opportunity. I started looking at the market differently. Instead of chasing hype, I divided it into different zones. You have the crowded zone, where everyone is already investing. The defensive zone, where businesses stay stable no matter what. And the speculative zone, driven mostly by hype and expectations. But the real opportunity sits somewhere else. The overlooked zone. This is where smaller and mid-sized companies are quietly using AI to solve real problems. Not building the technology, but applying it in smart ways. And here's the key idea most people miss. When a technology becomes widely available, the value doesn't stay with the companies that build it. It moves to the ones that use it best. Just like electricity. Just like the internet. And now, AI. So instead of only focusing on big tech, I started putting money into smaller and mid-sized businesses. These companies don't need billions. They just need to use AI efficiently. Lower costs. Faster execution. Real-world impact. Now let's talk about protection. Because every major shift creates opportunity, but also uncertainty. That's why I increased my allocation to gold and started holding more cash. Gold acts as long-term stability. And cash gives you flexibility. Most investors make one big mistake. They stay fully invested all the time. Then when life happens or markets drop, they're forced to sell at the worst possible moment. Cash protects you from that. And more importantly, it gives you the power to invest when real opportunities appear. So here's where I stand today. I still invest in the S&P 500, because if AI continues to grow, I want exposure to the companies leading that change. But I'm also diversifying. Across global markets. Smaller companies. Gold. And cash. Because the truth is simple. No one knows what happens next. The goal isn't to predict the future. It's to be prepared for multiple outcomes. That's how real wealth is built. Not by following the crowd, but by thinking ahead. If you want to learn how to start investing step by step, check out the next video. And if you're serious about building assets, make sure you subscribe. Stay in touch for more information.